Hi, in this video, I will be covering the foundation that will be required for anyone to understand what national income is and how national income is to be measured. But before we jump into the concepts of gross domestic product or net domestic product, we really need to know why there is a need to have a method for measuring economic output. First, you can say that it definitely allows one to compare, say, value of output produced by United States to that of China. But it has so many uses beyond comparison. It allows the economists to analyze the economy, and it allows the policymakers to decide whether they need to use a contractionary policy or an expansionary policy. It also conveys data about how economy is doing and works as a facet that can be used to understand key issues within the economy of a nation. Thus, we can safely say national income is an important concept. But it can be quite difficult to understand when we have so many terms measuring national output. We have GDP, we have NDP, we have GNP. And a lot of times these terms are being used simultaneously in different reports, newspapers, and publication. This must have made you wonder if these terms are the same and if they are interchangeable. Well, I'm here to tell you that these words are not the same. And therefore, before understanding how to measure national income, it is important for us to understand what these terms mean and what they stand for. So, let's get into it. We will start with GDP or gross domestic product at market price. GDP MP is the total market value of all the final goods and services produced by factors of production located within the domestic territory of a country. Within this definition, we have come across three different terms that you might be unfamiliar with: final goods and services, factors of production, and domestic territory. We need to understand what these terms mean in order to understand national income accounts. Let's take a look at final goods and services. Now, final goods and services are those that are used for ultimate use. For example, the pastries that you buy from bakery for consumption is an example of final good. But not all goods produced in an economy are considered to be final. And that is why understanding how to differentiate between a final good from a non-final good is important. The good that I have been calling non-final good is actually called an intermediate good. And these are those goods that undergo further processing or are used for resale by another firm. This means that their final form may be completely different than they originally were. That is, their final form may be a completely different product. Let's look at an example of a farmer that sells sugarcane to sugar mill owner, where sugarcane is further used to produce sugar. Here we can definitely say that the sugarcane is an intermediate good. But is the sugar that is produced by the mill a final good? Well, that depends. If I buy the sugar for my own consumption as a consumer, then that packet of sugar would definitely be considered as a final good. But now imagine I am a baker and I buy this packet of sugar and then use it as an ingredient to produce tarts. I sell these tarts to the market and other people buy it and eat it. The sugar here, we can clearly see, gets transformed into tarts before it is being consumed by the final consumer. And thus, here, sugar will be considered as an intermediate good. In national income accounting, we only include the value of final goods and services and we exclude the value of intermediate goods and services. And the reason behind this is very simple. It's the problem of double counting. We can understand what the problem of double counting is with the help of an example. Let's have a sugar mill purchase sugarcane from a farmer for $100. We then allow the sugar mill to sell the sugar to bakery for $150. The bakery then makes 50 pastries and sells each at $5 so that it earns a total of $250. If we don't take into consideration the concept of intermediate goods and assume that this is the entire economic activity in the nation, then our national income would be 100 plus 150 plus 250, which is equal to $500. Now this is a clearly inflated value, and can you guess why that is? It's because the price at which the sugar mill sells sugar to the bakery already includes the cost of sugarcane. Similarly, the bakery includes the cost of sugar while setting the price for the pastry. Thus, the best way to measure national income is either by only considering the value of the final goods, that is, the value of the pastries in entirety, or to measure the value added. What exactly is the value added? The sugarcane is sold for $100 and the sugar mill processes the sugarcane and adds a value of 150 minus 100, that is $50. The bakery buys the sugar for $150 and sells the pastry for $250. So the value added would be equal to 250 minus 150, which is equal to $100. Thus, the value of final good and service would be equal to 100 plus 50 plus 100, which is equal to 250, which is the same as the value of the final good. Thus, the value added explains the amount by which the value of a good and service, in this case sugarcane, is increased at each stage of its production process. So now that we know what final goods and services are and why only they are considered while measuring national income, let us move on to the second term, that is factors of production. Factors of production are the resources that are used to transform input into output. In economics, we mainly have 4 factors of production, and these are labor, capital, entrepreneurship, and land. Land as a factor of production refers to all the natural resources that are involved in the production process. Labor, on the other hand, implies the human effort that is required to convert inputs into outputs. Capital not only refers to the money but also the tools and machinery required in the production process. And lastly, we have entrepreneurship, which is the ability to combine all the other factors of production in order to create new goods and services. Now, all these factors of production are also paid for their services. For example, labor earns wages, capital is paid in the form of interest, land accrues rent, and entrepreneurship earns profit. The last term we need to look at is the domestic territory. Domestic territory refers to the political territory of a country, and this is different than the economic territory. For example, let's assume we have Apple, a company that is producing microchips for iPhone in China. The value of these microchips will not be considered as a part of gross domestic product of United States of America because the production is being carried out in the domestic territory of China. So now we have a fair understanding that GDP measures the goods and services produced by resources known as the factors of production within the political or geographical boundaries, or what we call the domestic territory of a country. In the beginning of the video, I had talked about that there are newspapers, we have publishings, we have economic papers that use different terms such as gross domestic product, net national product, net domestic product, etc. as a means of measuring national income. I had also talked about the fact that all these terms are completely different. So what I am going to do in this section of the video is that I am going to tell you how we derive all the other terms from GDP. First, let's see the transformation of gross domestic product into net domestic product. Here we are moving from gross to net, and this difference is made by depreciation. That is, GDP minus depreciation will give us NDP. What does this mean? One of the factors of production which is responsible for the creation of goods and service was capital. And capital such as tools and machinery undergoes wear and tear after each use. Thus, there is a fall in their absolute value. And this fall in the absolute value of the tools and machinery is what we call depreciation. Therefore, to measure the true value of capital, it is important that we subtract the value of depreciation from it. And when we do that, we move from gross to net. So, net domestic product refers to the goods and services produced by resources known as factors of production within the political geographical boundaries or the domestic territory of a country minus the depreciation. Net domestic product is a more accurate way of measuring national income remotely because the fall in value of assets is accounted for. However, you must keep in mind that measuring depreciation can get pretty difficult, and sometimes you may only get a representative value and not the accurate value. Next, we see how we move from NDP to NNP. And the difference is that we move from domestic product to national product. Here the concept of domestic territory comes into play. When we were talking about domestic product, it included goods and services that are produced within the domestic territory of a country by all the factors of production regardless of their residentship. However, when we are talking about national product, it includes only those goods and services that are produced by factors of production that are the residents of the country. These may be produced within or outside the domestic territory of a country. And to move from net domestic product to net national product, we have a term called net factor income from abroad. Net factor income from abroad is the difference between the factor income that the country receives from the rest of the world and the factor income that it pays to the rest of the world. So, net domestic product plus net factor income from abroad will give you net national product. Now, net factor income from abroad can either be positive or negative depending upon the fact that the factor income that a country pays to the rest of the world is greater than the factor income it receives or not. And therefore, NNP can either be a value that is greater than NDP or it can be a value that is smaller than NDP. The last movement that I'll cover is from net national product at market price to net national product at factor cost. That is, from market price there would be a movement towards factor cost. Now, market price refers to the price at which goods and services are sold in the market. And factor cost is the price at which the goods and services are produced. So, how do we reach the factor cost? First, we need to exclude the value of indirect taxes because the burden of this indirect taxes is borne by consumer in the market price itself. The second step is that we need to add subsidies because subsidies reduce the cost of production. Therefore, net national product at market price minus indirect taxes plus subsidies will give us net national product at factor cost. So, summarizing the movement, to move from gross to net, we subtract depreciation. To move from domestic to national, we add net factor income from abroad. And to move from market price to factor cost, We add subsidies and subtract indirect taxes. With this, I end the video. I hope that it was informational and that you learned something. If you have any queries, any doubts, any suggestions, I'm open to all of them and you can just comment it away and I will try my best to answer them. Thank you for watching the video and I hope to see you in the next one. Thank you.